Moving averages, like I said at the end of the previous video, these are my favorite technical indicator other than, of course, price action and volume. So let's learn more about moving averages and what they mean, what they represent, and how you can use them to just save yourself a lot of time. They are a great efficiency tool. The basics, extremely important tool in technical analysis in multiple ways, and this is why I would say this is my favorite of them. The main reason, they help save time by smoothing the data in order to make trend spotting quicker and easier. So pretend each MA is its own individual river, and then you can start to see trends that much better. I mean, is this a bullish river? Is this a bearish river? Moving averages make answering those questions much better. Now, sure, we can go and look at the upper and lower shadows of candlesticks and then determine higher lows or higher highs or lower lows, all that. But with the moving averages, things are just that much easier to see. They also can act as identification levels for support and resistance. And if you really want to get outside the box, they can just be used as trend lines too. Instead of trying to draw a trend line, just say, you know what, I'm just going to use that moving average. So they are a very multifaceted type tool. There's two types of moving averages. There is a simple moving average, an SMA, and then an exponential moving average, an EMA. And in my opinion, they are a must-use indicator. Of course, my opinion, but I think that I will have a strong case in showing why they are worth your time. However, this concept isn't anything new. I've been over it multiple times now in the course. However, moving averages kind of act like this. They're all doors, but what door you want to use is up to you. As long as you are saying, I'm going to enter a door, I'm going to use moving averages, then you're not going to hear any sort of argument or debate from me. However, what door you choose, that's going to be up to you. Moving averages, as you're going to see, are all sorts of values, really unlimited amount of values. I'm going to give you some starting points, but if you end up not using them, maybe you find a different value or a different, moving average type, then use that. But again, they're all, picture the moving averages as doors. As long as you are choosing a door and say, yeah, I'm going to open up a door, fine. Then you're not going to get any pushback from me. But in terms of what door you choose, that's definitely going to be up to you and, what you feel most comfortable with. Most comfortable, personal preference. It's hopefully you're seeing now that as a common theme throughout this course, but that's how charting is. That's why so many people stumble, because somebody comes at them and says you have to do it exactly like this, and then people aren't, consciously they may feel comfortable, but subconsciously they're like, it's just not jiving. I mean, we're all different creatures emotionally, and we all have different risk tolerance levels and comfort levels. As long as we're agreeing on the overarching concept, in this case, the overarching concept is use moving averages, then fine. But as far as the values, I'm not going to be that pretentious and sit here and tell you that you have to use this one. Let's first talk about the simple moving average, or SMA, as you will see it in chart annotations and such. These are created by taking the average closing price over a specified number of candlesticks. So some examples, because this trips up a lot of people, but just bear with me here. So just as an example, the 10 SMA on a daily chart gives you the average closing price of the past 10 candlesticks, which are days because we're on a daily chart of price action. Again, I want to say that a 10 SMA on the daily chart. So that's going to give you the average closing price, the past 10 candlesticks. So over the past 10 candlesticks, what is the average closing price? Now, what do these candlesticks represent? Remember, we're on a daily chart. So in other words, a 10 SMA on the daily chart is telling us the past 10, the average of the past 10 days of price action. Now, a 10 SMA on a 60-minute chart is going to give you the average closing price of the past 10 candlesticks. But what time frame are we on? We're on a 60-minute. So remember, what is a 60-minute? A 60-minute is telling us what's happening with that drama every hour. So 1 hour drama, new hour. What's happening in that hour of drama? Okay, what's happening in that next hour of drama? So the 10 SMA on a 60-minute chart is going to give us the average closing price, or the average drama over the past 10 hours. Where up here, the 10 SMA on a daily chart is giving us the past 10 days worth of drama as an average. So keep that in mind. And because of this, and like I said, this is what stumbles, the 10 SMA will look different across different time frames. The main question, and hey, I noticed that your value for the 50 SMA is different than mine. I said, well, what time frame are you looking at? I'm looking at the daily time frame. Oh, well, my analysis that I did was actually on, the 15-minute time frame. Oh, okay, because remember, what is being calculated? The past 10 what? The past 10 candlesticks of the 60-minute or the daily chart, those are going to give you different values. So keep that in mind. Moving averages are going to look different depending on the time frame that you're looking at. An average of 10 days worth of drama is going to be different than an average of 10 hours worth of drama or 10 5-minute periods of drama. Remember from the lesson a few videos back, candlesticks are powerful because we can look at every minute of drama if we wanted to. So of course, a 10 SMA on a 1-minute chart is going to look much different than the 10 SMA on a daily chart. I mean, an average of 10 days of drama compared to an average of 10 minutes of drama, yeah, that's going to be a very big distinction. They are a lagging indicator, so simple moving averages tells us what has already been happening. An average is using data from the past. An average of anything. Let's think of baseball batting average. That is telling us how has the person performed in the past. That's all it's going. It is lagging. And there are lots of misconceptions out there about this. A lot of people think that because moving averages cross, that all of a sudden means that something's going to explode in price. Well, it doesn't quite work like that because, again, that's all lagging information. Now, can it help confirm? Like, okay, yeah, wow, the environment is just changing that much more bullish or bearish? Yeah, absolutely. But does it mean something is 100% going to happen just because a moving average is cross? No, because it's all lagging, and it goes back to the last video. There's no secret. There's no holy grail formula. So in other words, leave the past in the past. Take these indicators for what they are. They're just a very nice efficiency tool to spot trends. Exponential moving averages, a little bit different. EMAs, if you see that on a chart analysis, that's what that is referring to. Again, I'm not going to harp on it as much, but a 10 EMA on a weekly chart gives you the average closing price of the past 10 candlesticks, which are weeks of price action. Whereas a 10 EMA on a 5-minute chart is going to give you the average closing price of the past 10 candlesticks, which are just 5 minutes. So in other words, 10 EMA on the weekly chart is going to give you the past closing price, average drama over 10 weeks. Whereas a 10 EMA on a 5-minute is going to give you an average drama of the past 50 minutes, right? Because 5 minutes each, and if there's 10 of them, 5 times 10, I think my math is right, is 50. So 10 weeks worth of drama averaged, or 50 minutes worth of drama averaged. Yes, sure, they're both a 10 EMA, but it matters what time frame they're on, so they are going to look different depending on the time frame. Now, EMAs, how do they really differ from SMAs? They are used to reduce the lagginess. I'm not sure if that's a word. I don't think it is. But they try to reduce the lagginess of the SMAs. So what they do, they apply more weight to recent prices rather than older prices. And if you want to get into all the math of them, feel free. But like I've hinted at and said, this is not a math course. We are not going to be breaking down mathematical formulas or working on proofs or derivatives or anything like that. So just know that the shorter the EMA period, the more weight is applied to recent price. In translation, EMAs just react quicker than SMAs. That's what I'm trying to get across here. Feel free to use those search engines if you want to do more research on the actual mathematics of an EMA. But at the end of the day, exponential moving averages react quicker than simple moving averages. So which moving average is for you? That's a very good question. So think back to those doors. There is no set in stone answer. I mean, it's all going to be a lot of experimentation, testing things out, paper trading, and seeing what you feel most comfortable with. Simple moving averages, they tend to be more applicable to swing traders and investors, because they are less jumpy compared to EMAs. Whereas an exponential moving average, tend to be more applicable to the short-term day traders because they are more jumpy, quicker moves can be captured. Quicker reactions can help to gauge entry and exit points better, but these are just general rules of thumb. They're just, I almost hesitated to put that in there because I don't want people to say, oh, see, they're better at gauging entry and exit points, so I'm for sure going to use EMAs. Well, maybe SMAs will work better for you. I don't know. You have to figure out what you are most comfortable with, but just know that EMAs are going to be jumpier, especially, the smaller and smaller period that you are using. This is all general theory, and I'm proud to admit that, as I've said. So I'm not going to, hash that anymore. But just as long as you say, yep, I am using a door, that's fine. What do I use? Well, I've used SMAs, I've used EMAs. Recently, SMAs have been, the thing that seemed to be working well for me. But if markets change at all a little bit, and I notice that EMAs seem to be, helping me out a little bit more, that's fine too. But, try them all out, figure out, what works for you, put on your chef's hat, and, put together a recipe that's going to give you, the best tasting meal. Trend identification. Like I said, this is the component of moving averages that I like the best because, they make my life easier. How do they make it easier? Well, they free up my time. I want to spend as least amount of time as possible looking at charts so I can go, play with my family and, do other things. I love charts, obviously, but I'm all about efficiency. So I want things that just make my life that much quicker. So uptrends, they are defined by small number MAs above bigger number MAs. So what do I mean by that? Well, right here we have an uptrend. We have an 8 and a 50. I hope we all can be on the same page in this math that 8 is a smaller number than 50. So because this 8 simple moving average is above the 50 moving average, this would be considered an uptrend. You can see here prices. Now, could you look at the shadows of the candles? Absolutely. Okay, we have that low, that low, that low, that low, and then our highs. We have that high, that high, that high. Yeah, you could do that. But I mean, just real quickly looking at this, I'm thinking, okay, that the overall that is an uptrend right now. Now, downtrends are defined when small numbers are below bigger number MAs. So the exact opposite. 8 is smaller than 50, but look at this. The 8 is now below where the 50 is. And looking just at, candlesticks. Okay, let's look at the highs. So we have a high here, there. Lows keep getting lower and lower and lower. So yeah, you could do it like that. But like I said, or you could just glance at the moving averages. Okay, orange line is less than the blue line, and you eventually you're going to memorize what colors are associated with what moving averages. So you're just going to know, okay, orange less than blue, downtrend. I mean, very simple. However, what we need to be careful of, and why, you got to remember back to the introduction to indicators. Some indicators, these ones in particular, the trend ones, are no good in sideways markets because look at this. This is what I like to call moving average spaghetti. I mean, you have the orange line up and down, up and down. You have the 50 going like this. So there's all sorts of crossovers. I mean, look at that. There isn't any. I mean, notice the nice distinction here. I mean, nice separation, nice spacing, just very clear action. Again, nice and down, nice spacing between them. Just very, just very riverish. And I know that's not a word, but look at the riverishness of this. I mean, just a nice uptrending. The current of this river is clearly up. The current of this river is clearly down. The current, just all over the place. So we want to avoid MA spaghetti. These are just not trending stocks. So really, how many moving averages should you have? More or less? Well, look at it like this. The more moving averages you use, the more confidence you can have in the strength of the overall river. However, this does come with a trade-off. This can sometimes become confusing, and it just blows up in your face and creates confusion. And again, this is where I speak from experience, and that is why I only use 3 when I'm trading, because my mind, this is a little bit too much. And this being defined, as this picture. I mean, I'm staring at it as I say this, but I forgot that you don't know what I'm staring at. But regardless, so what do I use? I use different combinations, and it depends on the style and strategy I'm using. But for my short-term river, I use the 8, the 10, the 13, or the 20. Sometimes I'm defining. So I want this is a good example of how with strategies things are going to differ. Here I'm calling the 13 and the 20 a short-term river, but sometimes I'm using them as a medium-term river, because that just depends on what I'm trying to accomplish, the style of the strategy. So sometimes moving averages may be considered short-term, other times they may be considered medium-term, or here I'm considering 31 and 50 as medium-term, but at other times, using them as longer-term. So it's just gonna depend on your strategy and such. But so again, do you have to use these? No, that's not what I'm saying. Can you use them as starting points to experiment with? Yeah, I would recommend that. Use these as starting points. So the short term, 8, 10, 13, 20. Medium term, 13, 20, 31, 50. I know 13 and 31 and even 8 sound a little bit kind of almost out of place, but there is a reason for those, and we'll get that or to that in the Fibonacci videos. But these are some good starting points. So when you look at this, remember, when smaller number moving averages are above bigger ones, that implies an uptrend. So let's just look at that real quick. We have the 8, which is smaller than 31, and you can see it is above 31. 31, which is smaller than 50, you can see it is above the 50. The 50, smaller than 100, and you can see above 100. 100, smaller than 200, you can see above 200. So in other words, there is lots and lots of want in this chart. This is a very powerful bullish river. You have all your moving averages. They all have nice separation between them. All the smaller ones are above the bigger number ones. So very nice looking chart. Now maybe you're looking at this and saying, wow, I mean, that looks pretty like a rainbow, but that's a little bit too many lines, especially when you'll be starting to draw support and resistance lines. Yeah, it could get pretty messy, but messy is a subjective term. Messy to one person may not be messy to somebody else. So, do what, best fits your strategy. But example here of just how the moving averages, you want to see them act. Smaller numbers need to be above bigger numbers for, bullish rivers. And I want to note real quick that as far as, well, you gave us the numbers, but what about SMA or EMA? Again, it varies depending on the strategy. Some could be SMAs, some could be EMAs, but I'm going to leave that up to you to experiment, because I know human tendency, they just tell me what to do. Well, we're all different. So, starting points right here, but do some experimentation. And when you experiment with things, that's the best practice you can get, is having a framework and getting kind of pointed in the right direction, shoved in the right direction, which is the point of this. I'm shoving you in the right direction, but now when you're out there experimenting on your own, figuring out, seeing how different things work, that's where the mass bulk of learning and experience is going to come from. Let's look at another example of this. So, not to insult your intelligence, but I want to make sure that I'm crystal clear. 8 is smaller than 31, right? However, in this case, it is less than the moving average. You can see now it's in front of this. 31 is smaller number than 50, and in this case, it is in front of the bigger number. 50 is smaller than 100, yet it is less than this one. It is in front of it. 100 is less than the 200, yet it is less than it. It is in front of the 200. So now we have the exact opposite. What is this telling us? That there is lots and lots of giving in this chart. All the rivers are flowing downwards. It is just a very bearish environment. And then you look over here, and who likes meatballs with their spaghetti? There's moving averages crossing all over the place. You have some smaller numbers that are above bigger numbers. You have some bigger numbers that are above other smaller numbers. This is just mass chaos. Just things are all over the place. This is a nasty looking chart. From a trend perspective, nasty looking chart, maybe from a trend perspective, but maybe some people are like, oh, I love these charts because you're getting all these swings. That could very well be the case. When I say nasty, I don't mean that you couldn't make money from it, because some strategies, and I'm sure some traders can make money from that. I'm just saying from a trend perspective, everybody can agree that that is just not trending. That is a trend disaster. It's a trend, spaghetti, and it's got some nice meatballs in it. I need to be careful with my wording because that whole chart may not be a disaster to some, but from looking at trend spotting, there just simply is no trend. There's no clear river or anything like that, a part of that chart. Finding bullish rivers, I just want to give you a general approach. That way you can, because everybody's situation is going to be unique depending on the scanner, depending on maybe what your broker offers. But I just want to give you a general kind of thing that you can try out. And then, of course, you can, mix this stuff around. But so depending, like I said, on your scanner and filter you're using, it's going to determine how many pieces of criteria you can use. If you're using a free site, then you may not be able to put in all these different bits of information. They may only let you put in a couple, maybe none at all, maybe more than this. Like I said, case by case, but definitely start off with your broker if they offer a scanner, and if not, then kind of branch out from there. But it's all, it's a very fluid situation in terms of, how many of these are going to be able to do. But, this is a general approach. But so keeping this in mind, you can apply it, to any sort of, situation. So, if possible, this is, the best way to do it. But, it doesn't change the overall general concept that we are looking for smaller numbers that are greater and bigger than the bigger numbers. So, right here, just a simple backbone of a scan would be you want to find charts where the 8 simple moving average is greater than, quick little refresher in math, that is the greater than symbol, where the 8 SMA is greater than the 31. You then want charts where the 31 is also greater than the 50. And then you also want 50 SMAs that are greater than the 100. And then finally, you want 100s that are greater than the 200. So what this, backbone concept is making sure that the 8 is going to be greater than the 200, because if it's greater than the 31 and the 31 is greater than the 50 and the 50 is greater than the 100 and the 100 is greater than the 200, then that's going to imply that the 8 is going to be greater than that. It's also going to imply that the 31 is going to be greater than that. Also going to imply that the 50 is greater than that. So it's basically just trying to find one of those big, nice, powerful, bullish rivers. So that scan is going to be trying to find charts that look like this in terms of all these moving averages are greater than, their bigger number. So that's what that scan is looking to find. Just so you don't get all distraught or think, well, this thing doesn't work, results will be limited because, if you're using every single one of those, that is, looking for stocks that would be in total bull mode. I mean, that would be a very powerful bullish river. So yes, they're out there, but don't expect, a bunch of charts to show up every single day or whatever period you're using when you run the scan, because, it's a very ideal setting. There's not many charts out there where those moving averages, are nice flowing in that direction, but they do exist. So I just don't want you to sit there and think, what, I only got 3 results? What, is my scanner broken? I don't want you wasting time calling up customer service because you think your scanner's broken because you didn't get that many results. Now you can mold and modify it where maybe you sacrifice a few things and that's going to give you, more results. But if you want to say, what? No, I only want to deal with powerful bullish rivers, and the moving averages need to meet and meet these criteria. Then hey, that's awesome. That's fine. Go for it. But just don't expect to sit there and have a huge amount of charts to choose from, because it's going to be very limited. But if you're comfortable with that, if that's what you want your strategy and goal to be, then I will never disagree with that. You have a plan. Your plan is that it'll be limited, but if it works for you, then awesome. Keep in mind, this backbone, I'm just using SMAs, but you could just as easily use EMAs if you wanted to. So you could, just mix and match, but just understand, remember, the overall concept here, that being when you have small number MAs right here, above bigger number MAs, 50, that's what you want for uptrends. And for downtrends, when you have small number, 8, that are below 50 SMA, so bigger numbers, that's when you have downtrends. That's the concept. That's what you want your filters to be telling you. where are these smaller number MAs above greater than the bigger number SMAs? That's the whole point of those filters. And it's a great way to just quickly find, I want uptrending stocks or I want downtrending stocks. That's a great way to do it very fast. And then of course, just if you're pulling up random charts, so when you go back and now just start to kind of type in random ticker symbols, look at the moving averages and say, well, is this trending upwards, downwards, or is this just, spaghetti? And, it's going to become very quick. So next lesson, we will go over put moving averages into action with our case studies and see how that now starts to interact with the candlesticks and the supports and resistances that we've been learning about.